Hi, welcome to episode 3 of the entry-level trading course by Valetax. My name is Ryan Ferry, market analyst and educator here. Today we're going to be discussing about currency pairs, pips, and lot size explained simply. Remember, this is a beginner and an entry-level course, and it's very important for us to really understand what currency pairs are and how they are translated in the digital foreign exchange market, and also explain how lot sizes work. So stay tuned. So first of all, we're going to start by what is a currency pair. Okay, so Forex is always traded in pairs. For example, the Euro USD. When you look at the price of the Euro USD, you're basically seeing how much of the quote currency is needed to buy 1 unit of the base currency. So one currency is bought while the other is sold. So next question we're going to have to answer is, what is quote currency and what is base currency? The base currency is usually the first currency that is mentioned before the second currency. So for example, here we have the euro against the USD. So in this currency pair, this becomes the base currency. Okay, while the USD becomes the quote currency. So what we're doing is we're trading the value of one currency against another currency. So if we say we are buying Euro USD, it means that we are buying the Euro USD because the euro is of better value and appreciating over the value of the USD. But if we say we are selling Euro USD, it means that the value of the euro is depreciating over the value of the USD. So we'll be selling the euro for more USD if the euro is weak, or we would be buying the euro if the USD is weak. Now, let's understand really how the base currency and the quote currency work, like I quickly explained on our previous slide. First currency is the base currency. The second currency is the quote currency. Price movement shows strength or weakness, and we have some common pairs. Now, price is measured simply in pips. So when we look at the price movement and how it shows strengths or it shows weaknesses, the first thing that comes to our mind is how many pips has it moved in the direction of the strong currency or against the direction of the weak currency. Now, there are different types of currency pairs. We have major pairs, we have minor pairs, and we have exotic pairs. For the major pairs, we're looking at currencies of major countries that have huge amount of influence in the financial markets. So we're looking at pairs paired against each other like the Euro USD, the GBP USD, USD JPY, while for the minor pairs, which usually are countries who do not have a lot of trade agreements or interactions within themselves that much. We have the Euro JPY, we have the GBP AUD, and pairs majorly without the USD attached to them sometimes are highly referred to as minor pairs. Now, for exotic pairs, these are pairs with countries of most likely growing economies which are growing massively in terms of trades, businesses, exchanges, and the USD is the base currency against those pairs. We refer to them as exotic pairs. So we have things like the USD Turkish Lira, which is the TRY. We have the USD South African Rand, which is the ZAR. We have the USD MXN, which is the Mexican Peso. We have the USD TNY, okay, we have the USD CNY, which is the Chinese yen. Okay, so these are exotic pairs. Yeah. So moving forward, let's talk about how we measure price movement in the market. So price is measured in the market, like I said earlier on, via what we refer to as a pip. A pip is the unit of movement in Forex. So basically, what it means that When prices change, if prices move, for instance, from 1.36500 on the Euro USD and moves to 1.36700, we believe that there's been a movement and change in price. Now, this is exactly where foreign exchange traders, Forex traders, make profits from. We take advantage of the changes in price to earn profits in the market. So, how does a PIP become important to a trader? First of all, it is accessibility for retail traders, meaning that it's the one through way retail traders can actually benefit from the market. High liquidity and smooth price movement translates to the ability for prices to change relatively fast because we are not changing extensively the whole pricing of that currency pair, meaning we are not specifically jumping from 1.35 to 1.33 in short seconds. Rather, we are moving in the cents of those currencies. So take, for instance, when prices move from, let's say in physical exchange, say you do an exchange, you bought something of $3.50. What we're really focused on is the cents part of it. So that change between $3.50 to $3.80, the difference between the 50 and the 80 cents is 30 cents. Now that is enough profit margin for retail traders to make accessible, returns from. Ability to trade both rising and falling markets. That is what the PIP gives to us. So we can see the fall and rising in prices for very short term. And over time, it also allows opportunity for capital growth, meaning that because of this rapid and smooth and high liquidity changes in prices, people can take advantage of these prices and grow their capital without having to wait years or months in order for them to buy physical Forex and keep it until prices make a huge change before they earn their profit. This is some of the advantage of what being a digital Forex trader feels like. Okay. So moving forward now, we talk about lot sizing. What is a lot size? Lot size determines how much you gain or lose per movement. Think of it as a stake when you go to play poker in a casino house. Okay, you know those chips on the board. Whenever you want to bet on a dice, on a rolling dice, yeah, on a roulette, you have to push in some chips. Those chips are basically stakes. They are risk. They are the amount of capital that you're willing to expose onto that bet. So view the lot size somehow in that manner. So this is where, beginners often make a mistake. They usually think that the bigger lot size increases, the better their potential profit. But they forget that that also exposes them to higher potential loss. So lot size is responsible for the amount of risk you're willing to take. And here's how lot sizes are calculated. So a standard lot is 100,000 unit of base currency. That is a large exposure. It is referred to as the biggest and the standard lot when it comes to the foreign exchange market. Now, a mini lot is a medium exposure. This usually is the best or the highest lot size exposure for retail traders below a certain liquidity threshold, because it allows you to be able to manage your risk properly, and shorter moves might also give you good profits. Micro lots is the small variation of a lot size, usually 0.01, while the mini lot is zero point 0.1 and the standard lot is 1.0. For the micro lot at 0.01, this is the standard manageable risk for a beginner trader. The beginner trader is advised and expected to use the 0.01 lot to begin his trading and understand how to then increase his risks over time as his experience develops. Now, there is another lot size, which is called the nano lot. The nano lot is usually for a cent account. Why? The cent account is a very small account, which is advised to be the best practicable live account for new traders. So traders are advised to demo trade, but if they insist that they want to trade live markets, the nano lot sizes is what is best for them, which is usually 0.001, or on brokerage firms like Valetax, where we already have a designated cent account, 0.01 remains, but this time around it is broken down into a nano size to facilitate trading on the small account, which is the cent account. Okay? And I hope that is understood. Now, moving forward, this is a take on understanding what pips, lot size, and risk management really are for a beginner. So pips is just price movement. It's how we measure price movement. Or prices have moved 10 pips. So what we want to do is look at the risk and multiply by the pip size. That would give us our expected profit target or expected loss risk capability. Now, it's important to note the measurement of movement is how you need to understand the calculation of pips. Lot size is to measure your risk, and risk management is what controls your survival in the market. Because the market is a high-paced, high-liquidity moving market, meaning that you have no control over it. The market is always a chaos, but what keeps you alive in a chaotic position is your ability to manage your risk, knowing when to enter, knowing when to get out, and knowing when to stay longer. That manages your risk. So how do you see this? Proper traders calculate their lot sizes based on how much they are willing to risk. So if, for instance, the calculation for pips to lot sizes is if there's 10 pips, a standard lot times 10 pips means $100 movement. If it's 20 pips on a standard lot, which is 1.0, means $20 movement for just $200 movement for just 20 pips. Now, if the lot size drops to a mini lot size, that becomes 0.1 lot times 10 pips, which automatically translates to 10 USD for 10 pips. So if you're risking 10 pips, okay, and you're using 0.1 lot size, it means that your risk is going to be $10. If you go to the micro lot, which is the 0.01, now 10 pips becomes just $1. So if you're risking 10 pips, you know you're putting $1 off your capital at risk. That is how lot size translates to pips. So the higher the pips, the higher the multiplication that calculates your risk and your possible profit target. You don't choose lot sizes because you feel confident. You choose it based on your risk management rules. So it means that you need to understand what the total risk is, and then you choose a lot size that matches what amount of capital you're willing to risk from your overall trading capital. And lot size directly can affect your emotions. The higher your lot size, the more emotional you might get about a trade that is moving or is in movement. If your lot size is too big, you might be faced with lots of emotions like fear, greed, and control. So we need to learn to manage our lot sizes. And thank you for watching the episode 3 of the entry-level course. And I'll see you in the next episode. I hope thus far you've been following and you're understanding.